Hi, everyone. Thank you for joining me again for another episode of the Optimize Wealth podcast. My name is Lance Norquest, investment advisor with Bellwether Wealth, and today we're focusing on behavioral mistakes investors still make even when they have professional advice. You might assume that having an advisor eliminates emotional decisions, but the truth is, even experienced investors still struggle with the same psychological traps. Because investing is not just about numbers, it's also about behavior. And behavior tends to show up most clearly when markets become volatile. One of the biggest behavioral mistakes we see is recency bias. That's a tendency to believe that whatever just happened in the market will keep happening. If markets have been strong, investors assume the rally will continue. And if markets have been falling, investors assume that it will keep getting worse. We saw a clear example of this over the past few years. In 2022, markets experienced a significant downturn. Inflation surged, interest rates rose rapidly, and the S&P 500 entered bear market territory. During that period, many investors did what emotions naturally push us to do. They moved money out of the market. But here's the challenge. Markets began recovering in 2023. And the rebound happened faster than many expected. So investors who sold during the fear often missed part of the recovery. That's a classic behavioral trap. Selling when fear is highest and buying back after markets have already recovered. Another behavioral pattern we've seen recently is performance chasing. Think about the excitement around artificial intelligence over the past couple of years. In 2023 and 2024, a small group of large technology companies drove major portion of the market gains. These companies became the center of market attention, and investors started pouring money into them. Part of that enthusiasm was belief in the technology, but part of it was simply because those stocks outperformed. This is also very common. When a handful of investments are doing well, investors often assume these winners will keep winning. But markets rarely move in straight lines. And when sentiment shifts, those same popular investments can correct quickly. Another interesting trend during this period was market concentration. At one point, a small group of mega cap companies represented a large share of the US stock market. Many people started calling them the Magnificent Seven. These are outstanding companies. But that level of concentration also tells us something about investor behavior. It shows how investors tend to cluster around the same ideas. This is what we like to call herd behavior. When a powerful narrative develops, investors often move in the same direction. So if behavioral mistakes are so common, what role does an advisor play? In many cases, the advisor's biggest value is not necessarily picking stocks. It's helping investors stay disciplined, because successful long-term investing requires something that sounds simple, but is often very difficult. Patience. Good advisors prepare clients for volatility before it happens. They show historical corrections, they explain that downturns are a normal part of investing, and they remind clients that volatility is simply the price we pay for long-term growth. Advisors also rely on a process instead of emotion. Things like regular portfolio rebalancing, dollar cost averaging, or maintaining a disciplined asset allocation. These systems help remove the urge to react to every market headline. Advisors also bring the conversation back to long-term goals. When markets drop, the key question is not, what is the market doing today? The real question should be, has your financial goal changed? Has your retirement timeline changed? Has your need for income changed? If those things haven't changed, the plan often shouldn't change either. And that leads to the bigger takeaway. Investment success usually isn't about finding the perfect portfolio. It's about sticking with a good one. Markets will always move through cycles. There will be periods of fear, and there will be periods of excitement. But the investors who tend to succeed are the ones who manage their behavior best. Because often, the biggest risk to a portfolio isn't the market itself, it's the investor's reaction to it. If you have questions or would like to discuss your investment plan, or strategies for staying disciplined during market volatility, please reach out. You can call our office at 402-476-8844 or by visiting our website at bellwetherwealth.com. That's all for today's episode. Thank you for watching. Again, my name is Lance Norquest with Bellwether Wealth, and we'll see you next time on the Optimize Wealth podcast.